Hey everyone, welcome back. We're diving into something that affects us all, U.S. family finances. We're going beyond like those quick headlines about the economy to really understand what happened to our wallets between 2019 and 2022.
Yeah, those years felt like a financial roller coaster, to say the least.
Exactly. And to do that, we're going to be using data straight from the source, the Federal Reserve Survey of Consumer Finances. It's like getting a detailed financial checkup for the entire country.
It's fascinating. We often hear these big pronouncements about the economy, but this lets us see how things actually played out for families on the ground.
Exactly. Get ready for some surprising insights. For example, did you know the pandemic might have actually helped some people financially?
I think you'll find the data reveals some interesting patterns.
Let's find out.
For example, let's start with income.
Okay.
We often hear that the pandemic caused incomes to drop, but the reality is more nuanced than that.
Okay, let's unpack that. What did the survey actually say about income during those years?
Well, it shows that the median family income did rise, but only by about 3%. What's really interesting is that the mean family income jumped a whopping 15% during the same period.
Hold on, back up a second. Why is there such a big difference between median and mean income? What does that even tell us?
That's a great question. It basically boils down to inequality. The median income is the middle point, meaning half of families earned more and half earned less. The mean income is the average when the average is much higher than the median. It means the highest earners are pulling that average up. So while most families saw some income growth, the wealthiest families saw the biggest gains.
So it's not just about whether incomes went up or down, it's about how those gains were distributed. Did the survey give us any insight into why some families did so much better than others?
It did. One of the clearest dividing lines was education.
Oh, okay.
Families with a college degree saw their incomes increase, while those without a degree saw little to no growth. This highlights a trend we've been seeing for a while now, a growing gap between those with and without a college education.
That makes sense. We hear a lot about the importance of education in today's economy, but this data really drives home just how significant that education gap can be for families' finances.
Absolutely, and it's not just about income either. The survey also looked at net worth, which is basically a snapshot of what families own minus what they owe. And get this, between 2019 and 2022, the median net worth shot up a massive 37%. That's the biggest jump ever recorded in the history of this survey.
Whoa, that's huge. So even with the pandemic and all the economic uncertainty, families were actually building wealth.
Exactly. This really challenges the doom and gloom narrative we often hear about the economy. And what's especially interesting is that this wasn't just driven by the wealthy. Getting wealthier net worth increased across different income and demographic groups.
Okay, so what was behind this massive surge in net worth? It can't all be explained by those modest income increases we talked about earlier.
You're right, income is just one piece of the puzzle. A major factor was the booming housing market. Remember those pandemic-era bidding wars we saw? Well, those translated into big gains for homeowners.
Yeah.
The median net housing value, which is the value of your home minus any debt you have on it, rose by an incredible 44%.
Wow, so let's say you owned a $250,000 home in 2019. With that 44% increase by 2022, your home equity would have jumped by over $110,000. That's life-changing for a lot of families.
It certainly is, however. This housing boom also had a downside. Even though home values went up, affordability took a hit. The median home price was over 4.6 times the median family income, a record high. This means buying a house became even more out of reach for many, especially those trying to buy for the first time.
So it's a classic case of mixed blessings. Those who already owned homes saw their wealth increase significantly, but it became even harder for others to get on the property ladder now. Besides housing, what other factors contributed to this surge in net worth? Did the pandemic affect how people invested their money?
Absolutely. One striking finding from the survey is the increase in direct stock ownership. It jumped from 15% to 21% of families, the largest increase ever recorded.
That's a big jump. It seems like a lot more people decided to invest in the stock market during this time. Was this driven by all those new investing apps we heard about?
That might have played a role, but it's important to remember that this period also saw a major bull market. Stock prices were hitting record highs, so it's natural that more people wanted to get in on the action.
And it seems like it paid off for many. If you were investing in stocks during this time, you probably saw some pretty decent returns. But what about retirement savings? Did people keep saving for their golden years, even with all the economic uncertainty?
Retirement savings did go up overall, but it's not as straightforward as it seems. The survey showed that savings grew for higher earners but actually declined for lower earners. This really highlights how economic trends can have very different impacts depending on your income level.
That's a really important point. It's not just about whether a particular indicator went up or down. It's about who benefited and who might have been left behind now, before we move on. I have to ask about something that really surprised me. The survey found that a whopping 20% of families own a business. That's a lot more entrepreneurs than I expected.
It is a significant number, and the pandemic seems to have impacted business ownership as well.
Yeah.
We saw an increase in business ownership, particularly among families in the bottom half of the income distribution and those in the top 10%.
So both ends of the income spectrum saw more people starting businesses. That's really interesting. I wonder what factors were driving that trend.
It's likely a combination of factors. For some, it was out of necessity. They might have lost their job and needed a new source of income. For others, it could have been an opportunity to pursue a passion or take advantage of new market conditions created by the pandemic.
It seems like the pandemic forced a lot of people to reevaluate their careers and maybe take a leap they wouldn't have considered otherwise. But I'm curious, what did these businesses look like? Were most people starting small, or were there some big ambitious ventures with lots of employees?
Most businesses were actually quite small. 78% employed fewer than 5 people, and 52% were non-employer firms, meaning they were essentially one-person operations.
So it seems like a lot of people were testing the water starting small and seeing what happened. That makes sense given the uncertainty of the times. But how did income and net worth differ for business owners depending on the size of their business? Did those with larger businesses have a significant advantage?
As you might expect, income and net worth increased with the number of employees. Families with larger businesses had significantly higher incomes and net worth compared to those with smaller businesses or no business at all.
That makes sense. More employees usually means more potential for revenue and growth. But what about financial security? Did business owners feel confident in their income, or were they more vulnerable than those who didn't own a business?
That's where things get interesting. Business owners, particularly those with smaller businesses, reported less certainty about their earnings than those who didn't own a business. This suggests that entrepreneurship, especially at the smaller scale, comes with a higher level of risk and volatility, at least in terms of income stability.
So even though owning a business can be a path to building wealth, it doesn't necessarily translate into a feeling of financial security, especially in the early stages. Now, let's shift gears and talk about the other side of the coin: debt. Did all this economic upheaval lead to families drowning in debt, or did people become more cautious with their borrowing?
Here's where things get really surprising. Despite the pandemic and all the uncertainty, all three measures of financial fragility, those indicators that show how vulnerable families are to economic shocks, actually declined between 2019 and 2022.
Wait, so families were actually in a better position to handle financial shocks in 2022 than they were in 2019. That seems counterintuitive. How is that even possible?
It is fascinating, isn't it? And it challenges some of our assumptions about how families would react during times of crisis. Let's break down some of these measures to see how this happened. For instance, the median leverage ratio for debtors, which compares a family's total debt to their total assets, dropped to 29.2%, its lowest level in 20 years.
Okay, so even though some families might have taken on more debt, their assets were growing even faster. But what about families who were already carrying a lot of debt? Did they see any improvements as well?
Yes, even families with higher debt burdens saw some positive changes. For example, the median debt-to-income ratio for debtors, which compares the amount of debt-to-income levels, remained stable since 2016 and was well below its levels from the previous decade.
So it sounds like, at least in the aggregate, families were doing a better job of managing their debt relative to their income, even if the total amount of debt might have increased slightly.
That's right. And if we look at the median payment-to-income ratio, which looks at debt payments as a share of income, we see an even more striking trend. This ratio hit its lowest level ever recorded in the survey, just 13.4%.
Wow, that's incredible. So families were, on average, spending a smaller percentage of their income on debt payments, even if they still had a lot of debt. That's a really encouraging sign.
It is encouraging and speaks to the resilience and adaptability of families in the face of economic uncertainty, but it's also important to dig deeper and understand what factors might have contributed to these improvements.
Absolutely. We can't just celebrate the positive trends without understanding what's driving them and whether they're sustainable in the long run. So in part 2 of this deep dive, we'll explore some of those factors in more detail, examining specific types of debt like mortgages, credit cards, and student loans, and looking at how different groups of families were impacted. We'll also explore how access to credit government assistance programs and changing financial behaviors might have played a role in shaping these trends.
It's going to be a fascinating exploration of how families navigated these tumultuous years and emerged in many ways stronger and more financially resilient than before.
So stay tuned for part two, where we'll unpack those trends and insights, helping you understand what this all means for you and your financial journey.
Welcome back. Last time we saw that overall American families weathered the financial storms of 2019 to 2022 better than many might have expected. But as we all know, personal finances aren't about the averages, they're about your specific situation. So now let's dig into some of the details that might resonate with you directly.
Right, because a 37% jump in net worth sounds great on paper, but it matters how that happened, right? Did people just get lucky with rising home values, or were there smarter choices being made too?
It's a mix of both, and that's where it gets interesting. Remember how we talked about those financial fragility measures going down? That's not just luck. It points to families being less vulnerable to shocks, for example. Fewer people were turning to those high-cost, short-term payday loans. In fact, the survey showed that the percentage of families using these loans in 2022 was the lowest it's been since they started tracking this data back in 2007.
So even in tough times, it seems like people were finding ways to avoid those debt traps that can really spiral out of control. Did the survey shed any light on what was helping people stay away from those kinds of loans?
It did. One factor was likely the government assistance programs that were put in place during the pandemic, things like stimulus checks and expanded unemployment benefits, provided a safety net for many families, helping them cover essential expenses and avoid taking on high-interest debt.
That makes sense. Those programs were designed to provide immediate relief, but it sounds like they might have had a longer-term impact on people's financial health as well.
It's certainly possible the survey also showed that families were generally doing a better job of keeping up with their existing debt payments. The percentage of families reporting late payments or being 2 months or more behind on their payments was significantly lower than what we saw after the 2008 financial crisis.
Okay, so even though debt levels might not have decreased dramatically, people were managing their debt more effectively and avoiding those really serious delinquencies that can wreak havoc on your finances.
Exactly. And this suggests that families were making conscious efforts to prioritize their financial obligations and stay on top of their payments now, while those overall debt numbers might not have changed dramatically. Let's look at some specific types of debt to see where those trends were playing out.
Right, because saying debt is pretty broad. We need to know if it's mostly mortgages, credit cards, student loans, or something else entirely. What did the survey reveal about those different categories?
Let's start with mortgages, which are usually the biggest debt for most families. Interestingly, even with those skyrocketing home values we discussed, mortgage debt actually remained fairly stable between 2019 and 2022.
So even though people's homes were worth a lot more, they weren't necessarily rushing to refinance or take out bigger mortgages. That's surprising.
It is. It seems like many homeowners were choosing to stay put with their existing mortgages, perhaps hesitant to take on more debt in an uncertain economy.
That suggests a certain level of prudence and responsibility, right? It's not just about grabbing as much money as you can. It's about making smart choices for the long term.
Exactly. Now let's move on to credit card debt, which often gets a bad rap here. We actually saw some good news. The median credit card balance for families carrying this type of debt dropped by 14% to $2,700 in 2022.
So people were actually paying down their credit card debt. What contributed to that trend? Was it just those government assistance programs, or were there other factors at play?
It's likely a combination of factors. Those stimulus checks and extra unemployment benefits probably gave some people the breathing room to pay down their debts, but there might also have been some behavioral changes happening. Maybe people were spending less overall because of lockdowns and restrictions, or perhaps they were simply more focused on paying down debt with any extra savings they had.
It's interesting how a crisis like the pandemic can sometimes lead to positive changes in people's financial habits. But what about student loans? They've been a huge burden for so many people, and the pause on payments during the pandemic added another layer of complexity. What did the survey tell us about how student loan debt was impacted?
You're right. Student loans are a critical part of the family finance picture. The survey showed that the median balance for families with student loan debt remained fairly steady at around $25,000, similar to 2019 levels.
So even with the pause on payments, the overall amount of student loan debt didn't change much.
Exactly. Now, remember that the pause on payments meant people weren't required to make payments.
Right.
So it's not surprising that the balances didn't decrease significantly. But here's where it gets interesting. Even though the overall amount of student loan debt remained relatively stable, we saw a shift in who was holding that debt.
Okay, so who was carrying the student loan burden? Was it still disproportionately impacting lower-income families?
Actually, the data shows a shift. Student loan debt became increasingly concentrated among higher earners. This suggests that those with higher incomes were more likely to have taken on debt for education, perhaps for graduate degrees or more expensive programs.
So the student loan landscape is changing, while lower income families might still be struggling with existing student loan debt. It seems like a larger share of the debt is shifting towards those with higher incomes.
That's right, and this raises a lot of questions about how the resumption of student loan payments will impact families going forward. Will those with higher incomes be better equipped to handle those payments? Or will we see a new wave of financial challenges as those payments come due?
Those are really important questions, and it's something we need to keep an eye on as we analyze the long-term effects of the pandemic on family finances. But now I want to shift gears a bit and talk about something we touched on earlier, access to credit.
Sure.
Did the pandemic have any impact on people's ability to get loans or credit cards?
The survey found that fewer families were being turned down for credit or felt discouraged from applying for fear of being denied. This suggests that access to credit wasn't a major obstacle for most families during this time.
That's good news. But was there anyone who was still facing challenges getting access to credit?
The data shows that families with lower credit scores, those who were younger, and those with lower incomes, were still more likely to report being turned down for credit or feeling discouraged from applying.
So while access to credit might have improved overall, there are still some groups who face barriers or biases in the system.
That's right. It highlights the importance of ensuring fair and equitable access to credit for everyone, regardless of their background or financial history.
Absolutely. Access to credit is essential for financial well-being, and we need to make sure that the system is working for everyone now.
Let's turn our attention to another important aspect of the survey: asset ownership. Did the pandemic cause any shifts in what families owned beyond those gains in housing and stock investments?
The survey revealed some interesting trends in asset ownership beyond those we've already discussed. For instance, remember how we talked about the increase in business ownership? Well, that contributed to changes in asset ownership as well.
So those new businesses were adding to families' overall assets. Yes. But there are also some interesting shifts in other types of assets. Ownership of things like second homes or timeshares actually declined slightly.
That makes sense with home prices soaring. It's understandable that investing in additional properties might have been less feasible for many. Did we see any changes in ownership of non-residential real estate, like commercial property or land?
Ownership of non-residential real estate also declined slightly. This might reflect broader trends like the rise of remote work and online shopping, which could be reducing the demand for traditional commercial spaces.
It seems like the pandemic might have accelerated those trends, leading people to reevaluate their investment strategies and perhaps focus more on their primary residences. But what about less traditional assets like cryptocurrency? Did the pandemic's digital boom lead to more people investing in crypto?
While the survey doesn't have specific data on cryptocurrency, it does include a category for other financial assets, which includes things like futures, contracts, royalties, and loans made to others. This category saw an increase in ownership, suggesting that some families might have been exploring alternative investment avenues during this period.
That's interesting. It seems like the pandemic might have pushed some people to diversify their portfolios and explore new investment options. But now let's circle back to those financial fragility measures we discussed earlier. While the overall picture looks positive, we know that certain groups might still be facing challenges. Did the survey tell us anything about which families might be more vulnerable?
The survey provides a lot of data on various indicators of financial distress, allowing us to identify potential areas of concern. While we saw that late payments on debt overall declined, some groups like younger families and those with lower incomes were still more likely to report falling behind on their payments.
It's a reminder that even within positive trends, there can be nuances and complexities. We can't just look at the averages we need to understand how different groups are experiencing these economic changes.
Absolutely, and this highlights the importance of tailoring financial advice and resources to the specific needs and challenges of different demographic groups. Another area of potential concern is credit card usage. While some families were paying down their credit card balances, others were increasingly reliant on credit cards to make ends meet.
So it's possible that some families are using credit cards as a temporary solution, but if those balances continue to grow, it could lead to bigger problems down the road. It's crucial to understand the potential consequences of increased credit card reliance, especially for those who might already be struggling financially.
You're absolutely right, and this underscores the need for financial education and resources to help families make informed decisions about credit card usage and debt management.
Knowledge is power when it comes to finances. The more people understand about debt interest rates and responsible credit card usage, the better equipped they'll be to navigate those challenges. But I'm also curious about the families who were turned down for credit or felt discouraged from applying. Were there any common threads or factors that contributed to those credit access challenges?
This survey sheds some light on those who faced credit constraints, as I mentioned earlier, families with lower credit scores. Those who were younger and those with lower incomes were more likely to report being turned down for credit or feeling discouraged from applying.
So it seems like access to credit isn't always equal, and certain groups face systemic barriers or biases in the system. It's not just about individual choices or financial habits. There are larger forces at play that can impact people's financial opportunities.
Exactly, and this underscores the importance of addressing those systemic barriers and ensuring fair and equitable access to credit for everyone, regardless of their background or circumstances.
Credit access is crucial for financial mobility and opportunity, and we need to make sure that the system is working for everyone, not just those who already have an advantage. Now, let's turn our attention to another important topic that often carries a lot of weight and emotion. Debt. Did the pandemic, with all its economic disruptions, lead to a surge in debt for families? Or were people actually finding ways to manage their debt more effectively? What did the survey data tell us about this?
It's a great question. And the survey data reveals some interesting insights into the debt landscape during those tumultuous years.
Yeah.
Overall, the level of debt did increase slightly between 2019 and 2022, but the percentage of families holding any type of debt actually remained relatively stable, hovering around 77%.
So even though more debt might have been circulating in the economy, it wasn't necessarily translating into a higher percentage of families taking on new debt.
That's right now when we look at the types of debt that were driving this increase. The most significant jump was in the category of other installment loans. This category includes a wide range of loans, such as those for furniture, appliances, durable goods, and even medical debt.
That makes sense with people spending more time at home during the pandemic. It's understandable that they might have invested in upgrading their living spaces or buying new appliances. And unfortunately, unexpected medical expenses can arise at any time, especially during a health crisis.
Exactly. And it's worth noting that this category also includes those buy now, pay later, BNPL plans, which have become increasingly popular in recent years.
Those BNPL plans can be tempting, especially when you're facing financial constraints, but I'm also wondering if they might be contributing to a culture of overspending or making it harder for people to track their overall debt.
It's a valid concern, while the survey doesn't provide specific data on the impact of BNPL plans. It's definitely an area that deserves more research and analysis as these plans become more prevalent.
Absolutely. It's important to understand how these new financial products are influencing people's spending habits and debt management strategies. But speaking of debt, let's not forget about mortgages. With those soaring home values we discussed earlier, were families taking on more mortgage debt as well?
Surprisingly, no mortgage debt remained relatively stable between 2019 and 2022. The median and mean amounts of home secured debt were essentially flat despite those significant gains in home values.
So it seems like people weren't necessarily rushing to refinance or take out larger mortgages even though their homes were worth more. Was this a sign of caution in the face of economic uncertainty, or were there other factors at play?
It's likely a combination of factors. Some homeowners might have been hesitant to take on more debt, especially given the unpredictable economic climate. Others might have been content with their current mortgage terms or simply didn't need to borrow more money.
That's interesting. It suggests a level of prudence and financial awareness among homeowners, recognizing that just because you have more equity in your home doesn't necessarily mean you should rush to borrow against it. Now let's shift gears and talk about student loan debt. We know it's been a major burden for many Americans, and the pandemic added a whole new layer of complexity with the pause on payments. Did the survey provide any insights into how the pandemic impacted student loan debt and the families carrying that debt?
Absolutely. The survey offers valuable data on student loan debt, revealing both continuities and shifts in the landscape. For example, the percentage of families holding student loan debt remained unchanged at 22%, similar to 2019 levels.
So even with all the economic disruptions, the overall prevalence of student loan debt didn't change much.
Exactly, however, while the percentage of families with student loan debt remained stable, there was a notable shift in the distribution of that debt.
Okay, so who was carrying the student loan burden? Was it still primarily lower income families?
Actually, we saw a shift towards higher earners holding a greater share of student loan debt. This suggests that those with higher incomes were more likely to have taken on debt for education, perhaps for graduate degrees or more expensive programs.
So the student loan landscape is evolving with a potential shift in who's holding the debt. But with the pause on payments ending, this raises a lot of questions about the future. How will this impact families as those payments come due? Will those with higher incomes be better equipped to handle them, or will we see a new wave of financial challenges?
Those are crucial questions. Unfortunately, the survey data can't predict the future. It'll be essential to continue monitoring the student loan landscape and the potential impact of resuming payments, especially as those higher earners might also be facing other economic pressures like inflation and rising interest rates.
It's definitely something to keep an eye on. Now, let's shift our focus to something that became particularly relevant during the pandemic. Access to financial services and resources. Did the pandemic, with its rapid shift toward digital technologies and remote interactions, have any impact on how families accessed financial services or sought financial advice? What did the survey reveal about this aspect of family finances?
You're right, the pandemic accelerated the move toward digital financial services, and the survey captures some interesting trends in this area. For example, online banking usage skyrocketed in 2022. A whopping 85% of families reported using online banking, up from 78% in 2019.
So, online banking became the norm for most families, but did this shift create any challenges for those who might not have been as comfortable or familiar with technology?
That's a valid concern. While online banking offers convenience and accessibility, it does require digital literacy and reliable internet access, which aren't equally distributed across all demographic groups. While the survey data doesn't specifically address these potential challenges, it's an important consideration as we evaluate the long-term implications of this digital shift.
Absolutely. We need to ensure that the move towards digital financial services doesn't leave anyone behind or create new forms of exclusion. But besides online banking, did families rely on any other resources for financial information or advice during this time?
Interestingly, while the internet remained the primary source of information for many personal connections, and business professionals also played a significant role in both borrowing and investing decisions.
It's reassuring to see that even in the digital age, people still value those personal relationships and the expertise of financial professionals. It's not just about finding information online, it's about having someone you trust to talk to and guide you through those complex financial decisions.
You're absolutely right. Financial decisions are often emotionally charged and can feel overwhelming, especially during times of uncertainty. Having access to trusted sources of information and advice can make all the difference.
Well said. Now, before we wrap up this part of our deep dive, I'm curious about how people felt about their overall financial security during this time. Did the pandemic, with all its uncertainties, erode people's confidence in their financial well-being? Or were families finding ways to adapt and maintain a sense of stability? What clues can we glean from the survey data about this subjective experience?
It's a great question. While the survey doesn't directly measure people's feelings or perceptions of financial security, we can gather some insights by looking at those indicators we've been discussing: debt burdens, credit market experiences, asset ownership, and so on.
So, by analyzing those objective indicators, we can try to piece together a picture of how families might have been feeling about their finances. What do those clues tell us? Were people generally optimistic or pessimistic about their financial futures?
The data paints a mixed picture. On the one hand, those improvements in financial fragility measures such as declining leverage ratios and payment-to-income ratios suggest that many families were in a stronger position to withstand financial shocks. On the other hand, there are some potential sources of anxiety. Those increases in other installment loans, which could be driven by BNPL plans, might be masking underlying financial stress or a tendency to overspend. And of course, the looming resumption of student loan payments could create significant financial strain for many families.
So, while objectively many families seem to be in better financial shape than they were pre-pandemic, there are still anxieties and uncertainties on the horizon. It's important to remember that financial well-being is multifaceted and goes beyond just the numbers. It's about feeling secure in control and confident in your ability to achieve your financial goals, both in the short term and the long term.
Well said. And that's a great segue into the final part of our deep dive. Next, we'll explore some of the broader implications of these findings. We'll discuss what these trends might tell us about the resilience and adaptability of families, the effectiveness of government interventions, and the potential for creating a more financially inclusive and secure future for everyone.
It's a reminder that even in the face of unprecedented challenges, there are opportunities for learning growth and positive change. So stay tuned for the final part of our deep dive, where we'll delve into those broader questions and leave you with some thought-provoking insights to ponder as you continue your own financial journey. Welcome back to our final segment on this deep dive into U.S. family finances. It's been a wild ride through the data, but what does it all mean? What can we take away from this snapshot of 2019 to 2022?
What strikes me is that despite facing a global pandemic, economic shutdowns, and all sorts of uncertainty, American families on average ended up in a stronger financial position than they started.
Yeah, that's remarkable.
It really is.
It challenges a lot of the doom and gloom narratives we often hear. We saw declining financial fragility, more people managing debt responsibly, even a surge in net worth driven partly by smart choices, not just rising home values. What do you think this tells us about how families adapt to tough times?
Well, I think it suggests a level of resilience and resourcefulness that we often overlook. Faced with unprecedented challenges, families found ways to adjust their spending, prioritize their financial obligations, and explore new opportunities.
It also makes you wonder about the role of those government assistance programs. We talked about how those stimulus checks and expanded unemployment benefits might have provided a short-term safety net, but looking at the data, it seems like those programs might have had a ripple effect, helping people avoid high-interest debt and make positive changes to their financial habits.
Yeah, it's definitely a possibility those programs were designed for immediate relief. But it's fascinating to see how they might have contributed to those longer-term improvements in financial health.
It highlights the importance of considering the unintended consequences of policies, both positive and negative. Sometimes a program designed for one purpose can have far-reaching effects that we don't fully anticipate. But it's not just about government intervention. We also saw families making smart choices, like paying down credit card debt and avoiding risky payday loans.
Right. It's a reminder that financial well-being is a two-way street. While policies and economic conditions play a role, individuals and families also have agency in shaping their financial outcomes. Making informed decisions, prioritizing financial goals, and building healthy financial habits are crucial regardless of external circumstances.
It's about taking control of your finances rather than letting your finances control you. Now, before we wrap up, I want to touch on one thing that really stood out to me. The increasing concentration of student loan debt among higher earners. What are your thoughts on this trend, and what does it mean for the future of student loan debt?
It's a complex issue with far-reaching implications. On the one hand, it suggests that higher education might be becoming increasingly stratified, with those from wealthier backgrounds more likely to pursue advanced degrees or attend more expensive institutions. This could exacerbate existing inequalities in access to education and earning potential. On the other hand, it also raises questions about how the resumption of student loan payments will impact those higher earners. Will they be better equipped to handle those payments? Or will we see a new wave of financial challenges as those payments come due, potentially impacting their ability to save, invest, or even buy homes?
It's definitely something to watch closely as we move forward. It's a reminder that while the overall picture of family finances might look positive, there are still challenges and potential vulnerabilities beneath the surface now. For our listeners who want to learn more and explore these trends in greater detail, where can they go to access the data and resources we've discussed today?
All of the data and analysis we've been exploring comes from the Federal Reserve Survey of Consumer Finances. It's an incredibly valuable resource for anyone who wants to understand the financial landscape in the U.S. You can find the full report and other related resources on the Federal Reserve's website.
We'll also include links to those resources on our show's website for easy access. And remember, this deep dive has been a snapshot of a specific point in time. Family finances are constantly evolving, influenced by a myriad of factors from personal choices to global events.
That's why it's so important to stay informed, stay curious, and keep those conversations about financial well-being going.
Absolutely. Understanding these trends, both the positive and the challenging, helps us make more informed decisions, advocate for policies that promote financial security, and ultimately build a more resilient and inclusive financial future for everyone.
I couldn't agree more.
Well, that wraps up our deep dive into U.S. family finances. Thanks for joining us on this journey through the data. We hope it's given you some food for thought and perhaps even inspired you to take a closer look at your own financial journey.
Remember, knowledge is power when it comes to finances.
And with that, we'll say goodbye for now. Until next time, keep exploring, keep learning, and keep those financial conversations going.